There is a growing concern that the inflation we're looking at now could lead to something worse, like a 1970s style inflation eventually. We're starting to see wages creep even higher along with prices. What's your view?
So thanks so much for having me here this afternoon. My view is not that we are going to reach a 1970s style of stagflation. I think that there have been a number of changes in terms of the structure of the global economy and the domestic economy, the structure of the labor force, technology, and kind of productivity gains that we've seen. So I'm not calling for a stagflationary environment. Right now, we're very focused on the inflationary pressures, which are very acutely supply side driven right now. Clearly, there's been a bit of a deceleration in demand and some top line numbers, and in GDP growth in Q3 exacerbated by kind of the terrible spike in coronavirus and the Delta wave. But there's still a lot of pent up demand. And so we're very focused on kind of how long it takes for that demand to play through the system and how quickly corporate America can react to these supply chain factors.
So what is your view then as we look at S&P 4600 now in terms of how much room we have to run? If I, for example, had cash to invest right now, would you suggest I buy stocks?
Well, I am a credit strategist at heart, so I'm not going to necessarily opine on the S&P 500. What I will say is investors are very focused on inflationary aligned or protected asset classes right now. We've seen a lot of interest in leveraged loans, the CLO market, started to see a little bit of choppier flows and demand for U.S. investment grade. But ultimately, it comes down to what is your investment mandate? Do you need a cash proxy? Do you need to put cash to work somewhere where you're earning somewhat more than zero? Then it feels like U.S. high yield is a pretty good bet. You have a shorter duration, improving fundamentals. But if you're really looking for the upside trade, then maybe corporate credit is not necessarily where you want to be in this current environment.
Yeah, we had a great story, I think last week, Finbar Flynn from Bloomberg News. And I know you just gave us your take on inflation. You're not as scared as everybody, but he wrote, global bond investors face an old enemy, inflation. And then he said the universe of fixed income assets doesn't look to offer much in the way of shelter. It's really a concern for investors if you're looking into credit, right?
It is absolutely a concern. I will say, though, there's still an awful lot of fixed income trading at negative yields right now. And so if the broader investor universe is so concerned about inflation, then there's something wrong in the global fixed income market, given all of those negative yields. And what we've seen in terms of the yield curve in the U.S., the flattening that's gone on indicates to me that investors are much more concerned about some sort of policy error, about really pulling forward rate hike expectations to address the supply side inflationary pressure. And that might not necessarily be the course that actually goes through the market. So I'm a little skeptical of what we've seen in terms of the front end of the market, but I also acknowledge that, USIG at 2% with inflation running at, 3 to 5%, depending on the metric you're looking at, doesn't feel like a wildly compelling trade at this stage.
What do you say about the flattening of the yield curve? It seems to be on everyone's mind, although when I look at it looks a little bit crazy when you look at a one-year chart, but if you pull out, it's clearly not as flat as it had been pre-pandemic.
Yeah, that's correct. And I think that some of the flattening is kind of a readjustment of growth expectations. Everyone was looking for this wild boom post-COVID and, getting the global economy back online in this kind of synchronized way. Unfortunately, we've seen some very specific idiosyncratic challenges, be it China and the property market there, be it some other specific EM-specific issues. So the recovery feels a little bit less globally synchronized, which is just going to slow things down. And then also you kind of add on to it the reality that some pandemic-related restrictions have also kind of slowed things down. So I think in the long end, you have this combination of still kind of a yield-starved investor universe looking for any sort of duration, plus the realization that it's going to take, baby steps to get really out of kind of the pandemic.
I say, so our control room has some really fast fingers. They just pulled up a 3-year chart of the 2s, 10s, which was great, and now the 5s, 30s. But I think last week the 20s, 30s inverted. You have some weirdness going on at the end of the curve. What's that all about?
So I'm a little bit less willing to kind of stick my neck out on 20s, 30s. Part of it is 20s is still a relatively new tenor. And so having that kind of off the run type dynamic does sometimes lead to some wonky valuations there. And the curve there is still inverted, not by all that much. So I think it has more to do with market technicals than any real call on kind of the long end of the market.
Let me just finally ask you, if you're looking for a place to go, if you had to pick a place, Winnie, where would you invest right now? I mean, even if it's not a great market for credit, what would you pick in terms of regions, in terms of industries?
Sure. So we are still very constructive on high yield energy. It's a little bit painful for me as a strategist, given that energy has been a very challenging trade over the past 7 years. That being said, we do have some pretty strong fundamental tailwinds at our back, management teams who have learned some really hard lessons over the past 7 years, and valuations that still look pretty attractive relative to all other things. We'll be closely looking at the OPEC Plus meeting this week and kind of what comes out after that. But we're still pretty constructive on high yield energy.